Hello everyone, welcome back. Here is Ali Talabi. Today we are going to talk about the third lesson from the first module, financial goals of the corporation. So before talking about the financial goals, we need to clarify a few notes. So we talk about the operation of the firm in the first lesson. We talk about the operation of the firm and how the firm operates. We talk about liabilities, we talk about shareholders' equities and assets. So we need to distinguish between two major concepts. So the first one is book value and market value. So when you're acquiring an asset, for example, you are paying $10,000 for an equipment, you record that on your books and say, okay, $10,000 buying equipment in cash, equipment is going up, $10,000 cash is going down by $10,000. However, when you're using that equipment over time, most probably the value of that equipment is going to change. So it's not the same thing. Most probably for equipment, it's going down. But for some items, the value might go up. For example, when you are talking about land or property, these are those type of assets which they actually gain value over time. So the value is going up. So we have to distinguish between the book value and market value. So that's the first note. The second note is regarding the shareholders' equity. So we mentioned shareholders' equity is one of the major sources of financing for firms. So we talk about liabilities or debt, and we talk about shareholders' equity. Most probably, the book value of the debt is not changing that much. For example, if you borrow $10,000 from the bank, $10,000 last year is still $10,000 this year, the principal, be careful, the principal or the original money you borrowed from the bank is not changing. For sure, you have to pay interest for that. No argument regarding that. However, the original value is not changing. So if you recorded $10,000 as your liabilities or debt, still this is $10,000. So we don't see that much difference between the book value and market value for debt or liabilities. However, when it comes to shareholders' equity, that's a different story. So shareholders' equity usually has two major components. So when you look at the books, you will see that one is the capital or contributed capital or share capital, different terms but the same concept, and the other it's called return earnings. I'm not going to talk about the return earnings for now. For sure you remember from accounting course, we'll talk about this in the future and how we actually derive the return earnings. For now, we are going to focus on capital or contributed capital. What is that? That's the money which is brought by shareholders, which is given by shareholders to the company. So when companies are selling their shares to the public, so they raise funds, they get money. So it's called contributed capital or share capital. So the original value is clear, that how much you raise from the shareholders. However, over time, because of the operation of the company, because the performance of the managers and the whole company, you will see the value of the firm might change. How you see that? How it is reflected? Actually, you see that in the stock market. So for sure, you can go to Yahoo Finance or different platforms. You go and look at, for example, Google. You look at the IBM. You look at Microsoft. So if, for example, you use MSFT, which is a ticker for Microsoft, you can see the daily stock prices. And you see even over the day, the price is going up and down, going up and down. So this is based on the supply and demand, how many shares are sold, how many shares are purchased, what is the ask price, bid price, what happened to the firm, new updates, new information, what's happening to economy, what's happening to the market. So all these are kind of reflected on the stock price. Long story short, the market value of the shares is different than the book value of the shares. So that what you see here as a capital, that's what's recorded in actually the balance sheet or the statement of financial position. However, what you see in the market most probably is different than what you see here as a part of the shareholders' equity. So here is the argument that the market value of the share is different than the book value. So let me make it a bit more clear. So for example, you look at the share price of the Microsoft and say, okay, the stock price of the Microsoft, let's say it's $200. So that's the price, $200. So it means you need to pay $200 to buy one share of Microsoft. However, you know there are several thousands of shares of Microsoft. I know it's over a million, so just for now, make it simple. Let's assume the number of shares is just 1,000 shares. So the number of shares of this company, Microsoft, is 1,000. So how we can calculate the total market value of the shares? Just simply, you need to multiply the stock price by the number of shares. So $200 times 1,000 shares, it just gives you $200,000. So you can say the market value of Microsoft based on the shares is $200,000 or 200 grand. So that's an argument here. Now we know what is the market value. Why we need all this argument? The point here is one of the major goals of any corporation should be serving its shareholders, because shareholders, those are the people who are bringing money to the company. So the major objective, so we can conclude the major objective of any corporation, any manager should be maximizing this market value. In other terms, sometimes it's used, instead of the market value of the shares, the wealth, the term wealth is used. So if you see maximizing the shareholders' wealth, that's the same argument, maximizing the market value of the shares. Because if the stock price is going up, if you are the shareholder of the company, you become richer. That's your wealth, that's your money. So maximizing shareholders' wealth, that's maximizing the market value of the shares. How I can increase the stock price? And as we argued in the beginning, the stock price is actually based on several factors. And one of the major ones is the performance of the managers and how the manager is performing. They're selling more, they can reduce the cost, they can provide or offer new services to their clients. So this is a kind of argument here. So maybe you say, Ali, there are several other goals or objectives for any corporation. For example, they need to be ethical. So they need to share, they need to be concerned about the social responsibility. And for sure you heard about CSR, corporate social responsibility. The shareholders, the company should be concerned about different type of stakeholders. Now, the argument is, if the managers are able to increase the share price, actually it's a good thing for all stakeholders, not just the shareholders. Maximizing the shareholders' wealth, it's actually good for society. It's one of the arguments. Why? Because they try just to attract more customers. They try to have happier customers, for example. Because if you don't have happy or satisfied customers, you cannot sell more, you cannot increase your prices, you cannot provide a better service. The argument here is so customers or client become satisfied, and in this case, you are actually considering another group of stakeholders. Same for the government. If you make more money, you need to pay more money to government. So government become happier. Why not? So it's more money, better for the government. Also, same for other group of stakeholders. For example, even for the competitors, you are making if you make it ethical, if you are making valid type of competitions, actually it is good for competitors because they actually compete with you. They try to make more innovative products, and actually you will have a dynamic market. So customers, clients, competitors, government, so other group of stakeholders. So that's one of the arguments. For sure, you cannot ignore any group of stakeholders. You need to make sure you are serving or considering all those stakeholders. So again, the argument here is maximizing the shareholders' wealth should be your major goal. It helps you actually to consider or fulfill other goals of corporation. So here is the last lesson, the third lesson of the first module. The next lesson, actually there won't be any lesson, will be kind of wrap up. So I will come back with some major hints and notes and questions which are related to these three lessons for the first module. So we'll wrap up the first module by looking at some hints and questions. So, but for now, have a wonderful day. Enjoy your time. This is Ali Talabi. Talk to you soon.